In addition to teaching people how to invest like a professional, part of the vision for this channel was for it to help people sift through all the crap on the internet from people who either have no idea what they're talking about or who are just trying to scare you. So today we're gonna go through some of the most common ways people try to scare you on the internet, using this recent video from Recession Consulting. He has 250,000 subs, so if you saw his channel, you might think, well, this guy definitely knows what he's talking about. I also have to point out that his banner says, raw truth, real data. So let's see how truthful his video really is. They'll almost always start with some grandiose claim to catch your attention. Let's jump into it.
The US debt bubble is growing bigger and bigger and bigger. And when this debt bubble pops, in fact, it might have already popped, we are going to see one of the biggest recession and financial crashes of all time.
Holy crap, one of the biggest crashes of all time. I better listen to this guy. Don't worry, he's actually very wrong. Next, they'll throw out some crazy stats like,
there is over $63 trillion in debt outstanding in America. That $63 trillion is comprised of consumer debt, government debt, and corporate debt.
Oh wow, that's a huge number. And then he says,
and it's over 3 times more than the total income that America brings in each year of $21 trillion.
Except that $21 trillion figure is only for personal income in the US. So let's take all the personal, government, and corporate debt, combine them into one figure, and then compare that to only the personal income figure. Yeah, let's just ignore corporate and government revenues. It'll be more alarming that way. Oh, while we're at it, let's also ignore any assets that people have, which also have gone up a lot. And we should also probably ignore the fact that with lower interest rates, the actual cost of the debt has gone down. And for good measure, we should also ignore the fact that a lot of these debts cancel each other out. Like, for example, some personal debt might be to corporations, maybe for a car loan. Well, that consumer debt is revenue for the corporation. Then as investors, we might buy corporate or government bonds, aka debt. So that debt of corporations and governments comes in as revenue for consumers. And one last reason why you should not let this scare you is that even if his numbers were fair and accurate and the income was 1/3 of the debt, would that be unsustainable? Well, think about your typical home loan. Most people put down 20%, so borrow 80%, but it's due over 30 years. So let's say you buy a $375,000 home and put down 20% or $75,000. So your mortgage is about $300,000. You make $100,000 a year, so your debt is 3x your income, the same scenario he laid out. Well, even at these crazy 5% mortgage rates these days, your monthly payment would be about $1,700, compared to most likely more than $6,000 a month of income after taxes, depending on which state you live in. Fairly sustainable. And the government doesn't pay anywhere near 5% on its debt. Would it be a bigger issue if rates went much higher and stayed there for many years? Yes, but it would take a long time, it would be gradual, so it would not cause a crash anytime soon. And it's a very unlikely scenario. Next clip.
These zombie companies are going to start to go bankrupt and they're going to go out of business, which is going to perpetuate a deep recession, deeper than most people can even imagine right now.
Oh my, there's been a big uptick in zombie companies making no profits? Well, how would I square that with the fact that US corporate profits are at their all-time high?
You could see a problem, and that's that the number of employees through the end of 2021 in America was actually below where it was in 2018, yet the number of businesses was 11% higher.
Well, yeah, we didn't have massive population growth, but we did have a surge in small business creation during the pandemic. I thought this country was built on our entrepreneurial spirit. How exactly is that a bad thing?
We have on the other end a bubble and an overabundance in the number of businesses that often lose money that are allowed to exist because of the raging debt bubble.
Oh, so new businesses should only be allowed to exist if they're profitable right off the bat. So our lives would all be better if Apple, Microsoft, Amazon, Netflix, and basically every other company didn't exist. Because it's pretty hard to start a business and earn revenue before you spend any money to develop a product, pay for office space, build a website, etc. So I guess no new businesses should be allowed to exist. That sounds like a great idea. Also, where's the evidence that there are so many unprofitable, debt-laden businesses?
When you begin to analyze the debt bubble, you start to see that this is all a house of cards. A house of cards that in recent years has been propped up by the US government spending money like a drunken sailor.
Oh, really? So government debt funded all of these businesses? So these are all state-owned enterprises? Last I checked, the government doesn't just borrow money to give it away to small businesses. If they do, someone please leave a comment below and tell me how I can get some.
The US federal government had $6.2 trillion in outstanding debt. Fast forward to today, and that's gone up by more than 500% all the way to $26 trillion. At the same time, consumer debt's gone up from $14 trillion to $18 trillion, while corporate debt's gone from $11 trillion to $20 trillion.
OMG. So much rising debt. How could this be sustainable? Well, like I said earlier, you can't just ignore the ability to pay for the debt. There's a reason income statements have both expenses and revenues. There's a reason balance sheets have both liabilities and assets, because both sides matter. There's also a reason commentators like this guy will simply ignore one side to mislead and scare people. Or they may just have no idea what they're talking about. There's a lot of that going around on the internet too. Here's why both sides matter. For a simple example, think about your current situation right now. You have an income. You have whatever debt you have. Maybe for a mortgage, car loan, business loan, credit cards, whatever. Now imagine your debt level doubled, but your income quadrupled. Would you be in a better situation or a worse one? Light bulb. That's what happened with government, household, and corporate debt. Yes, they've gone up in absolute terms, but interest rates on them have gone down and the revenues to offset them have gone up. So the affordability of the debt has actually gotten better and better. As you can see from these charts, for the government, debt has been getting more affordable since the 1980s, for households since 2008, and for corporations since at least 2010.
And this is ultimately what's going to crash the debt bubble, because now folks, that interest rates are up. If a consumer has a credit card, well, their credit card payments are going to go up and they can't take out as much credit card debt.
Actually, the Fed funds rate has almost no impact on credit card rates, which are often 15 to 20% higher, and you shouldn't be paying interest on your credit cards anyway. As long as you pay off your credit card bill on time every month, it won't matter what your interest rate is because you'll never pay for it.
If a corporation wants to issue a new corporate bond, well, now that corporate bond is going to be at a higher interest rate, which is going to deteriorate their profitability.
Actually, corporate interest payments were less than 1% of revenues in 2021. So even if they go up, it's not going to move the needle much on their profitability. For a particular company that's highly indebted and has a big portion of their bonds coming due in the next year, sure, maybe. But system-wide, no.
And then the big one is really the US government. As US government debt continues to roll, with a massive 59% of all government debt maturing over the next 4 years, they're going to have to refinance it at higher interest rates, which is going to increase the cost burden of government debt service.
Okay, this is where it gets good. So here what he's doing is ignoring the fact that we're coming off of all-time low interest rates, which have been locked in for years on a lot of government debt, and implying that rates will go a lot higher and stay there for a long time. But in reality, he doesn't know that, and it's actually totally inconsistent with the Fed's current projections, which have the Fed funds rate falling over the next couple of years. Once inflation gets under control and the economy is weaker, they're more likely to lower rates than raise them.
A debt bubble recession, well, that's the worst kind of recession. We saw in 2008 just how bad that could be when a debt bubble pops.
Oh wow, so now this is a bubble that's going to pop and it's going to be like 2008? I should definitely be scared. Even though this is not remotely like 2008. Back then, people were taking out zero interest loans. Don't really have those anymore. Or they got screwed on adjustable rate mortgages, or ARMs, that went up when interest rates did. Those aren't very common anymore either. Lots of people got houses that they shouldn't have because lending standards were so low. But that doesn't happen anymore, and a lot of banks took on way too much leverage, which they aren't legally allowed to do anymore. So actually, basically none of the things that led to the 2008 crash are happening right now.
But what potentially makes today worse than 2008 is the fact that we have to deal with record levels of inflation.
Oh, wow. It's going to be worse than 2008? But wait, how can you say we're at record levels of inflation?
Year over year, consumer prices in America are up by over 8%.
Oh, I see. You just have to remove all of history before the early 80s. Because if you go back further, you can see that inflation has actually been higher than this many times.
Now, if we go back to the 1970s, we can see that the debt levels were a much more manageable 147% of total income. And so that meant that when the inflation surged in the 70s and 80s, it was bad, but Americans actually were then able to take out more debt in following years to compensate for the fact that the cost of goods was higher.
No, they were able to take out more debt because interest rates fell significantly from more than 15% in 1981 to under 7% in 1986. Which made debt become more affordable. No one can predict the future, but the graphic from the 1970s was pretty typical of a business cycle. That one had more extreme inflation and interest rate increases than normal, but the pattern was the same. The economy runs hot, inflation goes up above the Fed's target, so they start raising rates to bring it down. That often causes a recession, and then once we're in a recession and inflation has come down, interest rates start coming down too. I don't know how high inflation will get this time around, but I do know that it will eventually come down, and so will interest rates. It might be painful as long as rates are high, and we don't know how long that will last, but they'd have to stay much higher for much longer than anyone expects for us to have anything remotely resembling a 2008 crash. Highly unlikely.
This is not just a US debt bubble, this is a global debt bubble.
Again, this is just simply a misunderstanding about how debt works, or worse, an attempt to mislead and scare people. But the same thing applies to the rest of the world. It's affordability of the debt, not the absolute debt level that matters.
And what's crazy to me is how similar right now in 2022 looks and feels to 2007.
It's crazy to me too. This should be good.
We're seeing so many of the same things play out. We have a debt bubble, we have a housing bubble, and a stock bubble, which are both deflating at the same time.
Okay, let's go one by one. Debt bubble. You know I don't think we have one of those if you watch the rest of this video up to this point. Next, we have a housing and stock bubble, both deflating at the same time. Well, first of all, 2007 didn't have a stock bubble deflating. The market was up in 2007 and only fell 6% from its peak in October until the end of the year. 2022 would be a much better example of that, with unsustainable tech and small cap valuations coming down from record highs and the market selling off over 20%. So compared to 2007, a lot more of the equity market downside is already behind us. And then with housing, in 2007, house prices had already been falling for a while since 2006. In 2022, they've kept right on going up, which is a big reason why inflation has been so high. Tell me, do these two arrows look the same to you? So, debt isn't in a bubble because it's actually more affordable than it's been in years. The stock market has already fallen a lot further than it had in 2007, so there's not as much room for downside there now as there was then. And house prices have been rising, not falling, with owners much less leveraged and a strong labor market to support future mortgage payments. So yeah, it's totally just like 2007.
In terms of declines in asset values, whether it be real estate or stocks, I think they're going to be similar to what they were from 2007 to 2012, and perhaps worse in certain cases, because as economist Nouriel Roubini points out.
Okay, before I show you what he said, you should know that Nouriel Roubini is nicknamed Dr. Doom, and he's what I would call a perma-bear, meaning he's permanently bearish and is always predicting the next market crash. You'll often see headlines about outrageous market calls from perma-bears that will say something like, the economist who predicted the 2008 financial collapse now says ... And that's just an attempt to scare you. You have to consider the source. And I like Nouriel Roubini. His book, Crisis Economics, is the best book I've read on the 2008 crash. But you have to take his predictions with a grain of salt because he's pretty much always negative. And when you're always predicting a crash, you're pretty much guaranteed to predict the next crash. But you'll be wrong a lot more often than you're right. So to show you what I mean, let's take a quick look back at some of his prior predictions. In 2009, he said we were going into a double dip recession. Then in 2010, we were poised for a 20% market crash. In 2011, he said a double dip recession was a foregone conclusion. In 2012, he said we could be headed back into a recession. So you can go on Google or TikTok now, but I don't know if those Gen Zers know their history, their market history at least. But you can search this and look at it every year. So when someone tells you that Nouriel Roubini or any other perma-bear says we're going into a
stagflationary debt crisis, something that this world has never seen,
you should be skeptical. By the way, the world has seen that plenty of times. In fact, a debt crisis is pretty much always the cause of stagflation. But I digress. I hope this video has helped give you some examples of ways that the media, whether official or unofficial, can try to twist things to scare you. They'll often use big, scary language, make bold statements using totally misleading or incomplete data to back them up, or simply not back them up at all. They'll imply that some things are certain, which are actually not certain, or maybe not even likely, and they'll cherry pick quotes from people that sound reliable, like business leaders or economists, but who actually have a history of wild and highly inaccurate statements that just so happen to conveniently align with the commentator's opinion. The reality is that we don't usually have major market crashes and depressions and horrible world-ending things, but there's always someone out there predicting them. and they get paid when you click on their article, watch their video, or buy their book. They don't have to be right. They only have to get your attention. But I know that for most of you out there who aren't professional investors, a lot of this stuff can sound really credible if it's well done, like the video I featured today. So I want you to know that I'm here to help. If you see an alarmist headline that's got you worried, please let me know in the comments below or on any of my videos, and I'll either respond directly or I'll make a video about it. So click subscribe, hit the bell, and I'll do everything I can to make sure that your days of being scared and misled by financial commentators are over. And if you really want to learn how to invest, check out my free webinar below called The 9 Habits of Successful Investors. The link is in the description. Thank you for watching, and I will see you in the next video.